What is your view on, for instance, the equity markets? Because I hear now that investors, they're trying to turn more out of bonds into equities. How do you look at it?
Well, we do a little bit similar things, actually, to be honest, because we also think that, okay, yields by and large on the bond side, I think we've seen most of it. The big move actually was definitely from the high yield environment to the very, very low yield environment that we're currently in. We think we're going to stay in that low yield environment for some time, but the carry on the bond side is not that large. So that's why we have to have some extra kicker, either by going, which we are doing, some of the higher yielding bonds, not high yield bonds, but higher yielding bonds, something that offers more return for the money that you actually are currently getting in the government bond market. But then on top of things, of course, we're also looking at the equity market and looking at some very attractive levels there. Dividend yields have actually moved above bond yields for the first time basically in the last 10 years, in the last 3 to 6 months. So it looks much more attractive right now looking at the equity market in some instances basically than the bond market. So yes, by and large, in a nutshell, we think equity markets should tend to go higher. I think also we have to be very careful by differentiating on the equity side. Core European equity markets in particular basically I think will be going higher, while the periphery, including also some of the United States companies basically, will not necessarily be the outperformer. And so that you have to be very careful. It's not a homogenized world these days anymore. It's very complicated at the moment with the different cycles moving not necessarily hand in hand anymore at this stage.
Why should people buy funds of Aetna? Because we can already buy more than 100 investment funds in the Netherlands, and you dare to take the step to come in.
Clearly, basically, Aetna has a history basically of like providing very open, very risk minimized wealth management funds to the public for the last 8 years by now, and quite successfully so. We've managed to actually break into the German market, Swiss market, and other European markets. And we thought maybe the time was right basically also to look at the Dutch market and offering Dutch investors the same opportunities. Our main concern always is basically to have we have 2 funds, as you mentioned before. One is the largest fund, that's the Aetna Active E, which has the equity portion in that fund can be all the way up to 50%. But even in that fund, we can be invested only into cash up to 100%. If we don't know what we want to be doing, we can be actually up to 100% cash. Then we have the Aetna Global Defensive, which actually differentiates from the Active E only by the equity portion. It can be up to 10% in equity only, because it's much more bond-centric. It's a little bit low risk with low volatility in the fund. So we think basically it's like geared more towards people that want it even safer than the Active E so far. And the differentiation point to our competitors, I would say, is we take a very macro approach, very careful approach. We want to be risk minimizing our investments as opposed to maximizing the return. We rather leave percentage points returns actually on the table for some extra risk points. If we think the risk is unnecessary, we rather actually stay on the outside. We also only invest basically in things that we understand, very simple things, very simple bonds, very simple equity, things that most investors out there would understand. We don't do any structured products, any CDOs, ABSs, or anything like that, any of those complicated things. We rather stick only to the things that me and my colleagues do understand very well. We have a history of more than 25 years by now, experience in the markets. We come from both angles. I come from the credit bond side, and my colleagues come from the equity side. So it's a very good mix-up and very good link in that respect. I think works.
You're a multi-asset fund. Which asset classes do you invest in?
Well, we basically invest in anything, equity, bonds, currencies, by and large, but that's really it. So it's just a basic fundamental things of the market.
Yeah, I think my last question would be about just your view on the let's say, talk about Europe and the US.
Okay. The problems that we're currently experiencing also in the euro at the moment, which are huge and gigantic, I think will be resolved in some form or fashion. Not because it's maybe not necessarily economically sensible, but it's a political will basically that will force the euro to stay together, and that will also deal with the questions, with the problems basically that the euro currently actually has. So that's why I think Europe by itself basically will grow probably at a stronger rate than the US will be growing. So there will be a growth differential on the positive side towards Germany, which will lead of course to an outperformance of core European equity versus core North American equities, let's say. At the same time, basically, we will see probably yields moving in core Europe slightly higher than the US yields. Again, for the same reason, the growth here is stronger. And of course, basically, given the fact that we have like a gigantic debt problems to stem at some time, I think there will be some fear of inflation coming at a later stage at the end of next year, or even a little bit further down the road. Not actual inflation, but fear of inflation may be an issue at some stage in time. Now, clearly people are a little concerned about inflation. That's why gold prices are up, etc. But in principle, I think the growth differential certainly is in favor of core Europe at the moment.
You don't expect inflation in short term?
No, definitely not. Not over the next 12 to 24 months. Definitely no measurable inflation uptake. No.
Okay, thank you very much.
Thank you very much.